Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast with Bill Condon and Matt McGregor. We are in South Carolina at IAMC Conference, and we have a great guest today, Michael Mikulski, who's the National Business Development Manager for Incentives and Credits at ADP, based in Philadelphia. You've been with ADP for close to about 12 years now. Is that about right?
That's correct, yes.
Yeah. Tell us a little bit about yourself and kind of what you do for fun in Philadelphia.
Okay, great. So I'm pretty self-deprecating about all this, but I'm a true homeboy. I was born in Philadelphia. I've lived in the suburbs now my entire life. Our kids all live in Philadelphia, where I have 25 first cousins on my mom's side, and the majority of them live in the Philadelphia area. So it's the classic Philly thing where nobody leaves, right? So would have a undergrad, master's, and from LaSalle. Been working in the real estate, credits, incentives development business, for 30 years now in all kinds of different roles. But this is my second tour of duty in the incentives and credits world.
Awesome. So thanks again for joining us.
Well,
we appreciate it.
This is fun. Thanks.
Yeah, let's take a little bit of a deep dive. Tell us first about your company, and then we'll jump specifically into your role. But what does ADP do? And I think a lot of people know them on the payroll side, but let's talk about your world.
Yeah, so it's interesting. My role is the National Director of Negotiated Incentives and Credits. So we have a team that does site selection and then does all the negotiations for federal, state, and local incentives and credits. It's part of a larger tax credits team. It's probably $150 million business for ADP on an annual basis. It's one of the larger credits businesses in the country, but it's tucked inside a $19 billion human capital management machine.
Wow.
So my job is to convince people, yes, we actually are good at this and we do it well. And ADP is just a natural for this kind of business because so much of what credits and incentives involve headcount growth or relocation. So, and we're pretty good at that. And the other part of that is that we have incredible admin and compliance team. We actually commit on every deal to doing the admin and compliance for the entire 10, 15, 20 years of the length of an incentives package. But we actually have invested several $100 million in a platform that allows in real time the client to see on their desktop where the incentives packages are, if they've hired enough people, if they're under audit, so it's in real time. So it also prompts the client when there's a new credit or that might be available in a location across the country. That hey, did you know that they just passed a new law and there's a credit there that you can get in Tennessee that you might be eligible for? Can we help you get it? Mm-hmm. So it's a really neat tool that I think differentiates us amongst others.
That's great. Let's take a step back just for the listener and the brokers that are listening to this. Take a step back and let's just say you're a 500,000 square foot requirement. We hire ADP and we're looking at the tri-state area of Indiana, Kentucky, Tennessee. Mm-hmm. What do you do? What are the results? And how do you formulate what you do?
So this is really interesting because in about 45 minutes, we're presenting a case study, a company called Ollie's, where almost the exact scenario.
The grocer?
So the sub-market retailer, the discount retailer, yep. Ollie's. Yeah. So the project we're talking about, we end up helping them locate and get the incentives. And actually part of our team, we actually brought in ARCO to do the design build. A 700,000 square foot distribution facility. It was between Indiana, Illinois, and Iowa. Okay. And so we put a team together. It was Lead Associates was the broker, and ADP was the incentives and credits piece to it. And another partner of ours, Global Location Strategies, did the label analytics, commuting patterns, things like that. So we put together this really powerful partnership of providers and made it seamless to the client. And we got a tremendous result. So really what we do best.
Give us an example of the results.
So
what did you qualify? How did they qualify? And how did you leverage state over state?
So it came down to 2 states, and fortuitously for us, Illinois was very aggressive and enthusiastic, and we happened to pick a location in the state that worked for the from the logistical perspective, but just is a part of the state where Illinois was looking to create some headcount, some employment. So they really stepped up, and I don't want to be disparaging. I'll just say Iowa wasn't as aggressive.
Mm-hmm.
Sure. I think that's the right way to say it. And that's because Iowa had many more of those types of facilities already in tow, so they just didn't feel like they wanted to have any more of that kind of use. So we're kind of fortunate that way that Illinois stepped up.
And an example like that, like if Illinois steps up, that's credits for tax incentives, that's job training. Like, what are the types of achievements?
Well, so there was three pieces to this one. There was a property tax abatement, sales tax abatement, and then they're called the Illinois Edge Credit, which is based on headcount.
Right.
So
excellent.
Yeah, that's a great example.
Absolutely.
What are some of the kind of emerging trends you're starting to see in your space?
So it's interesting. I was thinking about this, and I made some notes about in preparation. One of the things, I don't know if I want to call it a trend because I might be being a bit egocentric on the opportunities we're getting. I'm seeing a lot more, especially larger companies, foregoing leasing, a build-to-suit lease, and then using their own capital and do a build-to-own.
Yeah.
Because their cost of capital is so much less expensive than even the largest developers. So, and with the lease rates doubling on these renewals, doubling and tripling, as you'll probably see in a lot of markets, what used to be a foregone conclusion that a company could get better returns simply by investing in their own business, the real estate returns now are looking better. They may not compare on their what they do for a living, but it's close enough where it makes sense and it could be a profit center for them.
Yeah. Yeah, and owning your facility, you have more control over it.
That's right.
Especially if you're putting a lot of infrastructure within the facility.
Exactly.
It can make a lot more sense than
Exactly.
leasing.
That's right. Now, again, historically, as we know, corporate owners of facilities tend not to be the best caretakers for those facilities.
Yeah.
But if you're going to spend that much money, you're going to use your own capital, it seems to me that they'll start spending more money to actually taking care of the buildings than you would think, because it becomes an asset that won't depreciate. It's interesting. I'm interested to see if in the world of accounting, if some of these larger Fortune 500s start turning off the depreciation, because it's not a depreciating asset right now, right? And it's been that way for a while.
Yeah.
So it'll be interesting to see how that, it might be too early to call it an emerging trend. I think emerging consideration is that good way to say it.
Yeah, that's a good point. We're seeing it more in our space too. Users purchasing buildings again.
Sure.
Yeah.
Oh yeah, it's a growing trend.
Yeah,
There's no doubt about it.
Right.
I've got a question on the size of deals. We always think of incentives as that, big requirement.
Sure.
Hundreds of jobs, if not more. What's the smallest one that's somebody that's, maybe in manufacturing and looking at a couple of different states? What's the smallest deal that would be considered achievable to get some incentive?
What's unique about the incentives process is that every state has a different packages of incentives, different types. Every state is trying to attract different types of users, and some have niche users that they're trying to attract. So we always tell a potential customer that if you're going to create at least 50 jobs or relocate jobs and spend at least $5 million in CapEx, we want to talk.
Okay.
And we're willing to evaluate and say, well, if you're thinking about these states, we can give them a range. Like if you're going to, on this project, if you put it in the state, it's going to be somewhere between $350,000 and $1.5 million, depending on some factors. And then we let them decide whether you want to go forward. One of the things about ADP is that, because we have 1.2 million payroll customers. So, and they're not all Fortune 500. That was my funny little joke. But we have a lot of pizza shops, right? I use that. So we apply that to smaller users. And so in our incentives and credits world, it's the same thing. We're happy to work with a customer who's only going to create 50 jobs and build a $7 million facility. That's, that it's not that big in the scale that we typically work on, but it's incredibly important to them. And that $500,000 to $1 million is meaningful to them.
Mm-hmm.
So we're willing to do that.
Yes.
So we're willing to hit singles.
Yep.
So
we're seeing huge shifts, obviously, in the industrial sector coming out of COVID. So we've had a big swing. What are some of the big impacts right now affecting your world for incentives?
Well, it's interesting. I was talking to my colleague in preparing for the podcast, and And one of the things and this is, even though it's not a really new or emerging trend, but the return to office debate rages on.
Yes.
Mhm.
I was kind of aligning with the 4 stages of grief.
Yeah.
And I think we're in the reorg recovery part of that, but there isn't any clear path yet. I mean, my significant other works for a J&J subsidiary, Janssen, and they're at least in the Philadelphia market, they're pushing all their employees to come back to the office 3-4 days a week. I mean, it's mandatory, and they're checking fob swipes and all.
Yeah, yeah.
So others, and then I have my oldest son works as an underwriter for Chubb in Philly, and they do 3 days a week, and they're not. I'll put it to, they're not checking fobs.
Right.
Okay, but there's a flexibility. They're not making it like mandatory in the sense that you have to be there.
8 to
2,
5.
right. So
Mhm.
it's like they just sort of like they treat them like adults.
Yes.
But there is an expectation for them to be there because that they want them there. Because they get real benefit from sharing work and water cooler talk, so forth.
Yeah.
So.
Yeah, that is a really interesting one. We just had Michelle Needles on a podcast, and we were talking about the same thing. And it is still unknown.
This comes up on almost every podcast.
Yeah,
right?
yeah.
And it's also impactful from in the incentives and credits business too.
Yeah.
Oh, true.
Because
true.
incentives and credits are driven
Within the state.
but people locating to a
Bodies.
facility,
Yeah.
in
Yes,
a place.
Yeah.
Like
Yeah.
it's so interesting because during that transition out of COVID, a lot of states cracked down and took the incentives away if they didn't fulfill the in-house requirements, right?
Mhm.
And so even though they were working from home in the
Great
state,
point.
so but what states you're seeing, some states now are now saying, okay, we make it about the location. If you've got the employee in the state and it's a new job, we'll provide incentives for that.
As long as the tax burden is in.
Exactly
in that
right.
state.
That's
Yeah.
exactly
Yeah.
right. That's
Yeah.
exactly right.
Let's talk a little bit about sustainability. Obviously, a big, people are becoming more and more relevant every single day, right?
Yeah.
How does sustainability and other kind of environmental impacts, how does that play out in the incentive space?
It's very interesting. And I hope if I'm going too much of a tangent, please.
No, you're great.
So from our standpoint, the CHIPS Act and the Inflation Reduction Act are really, those are sustainability incentives. I mean, and they're really well-crafted legislation. The incentives are federal-based, of course, but they also, as part of that bill, gave money to all the state EDAs, and there was a lot of requirements. Like if you're going to qualify for that money, you have to do site selection in 3 states. You have to negotiate incentive packages in those 3 states because it has to be competitive.
Mm-hmm.
So it's really, but it's creating this huge demand. The first tranche was $4 billion. They had $40 billion in subscription for it. $40 billion. Now, again, this is why companies like us exist. There was a position paper, a feedback put out by the federal government. Many of the applications were wrong. They get tossed out, but just crazy things like just not even using the right project category. I think that's
Simple stuff. Yeah.
Right. So everybody criticizes the feds and even the states for putting these complex types of packages together or incentive programs together, but they have to be. And so, I know that sounds a little bit self-serving maybe, but because that means there's more work for us, but they have to be because the only way they can hold the incentive company in the exact way it needs to be done so that the local territory gets the investment that they need and gets the job creation. So it's to be that bridge. And they also, the second thing is the federal government has every right. If we're going to award a company hundreds of millions of dollars,
Yeah.
I mean, at least the companies should take the time to do it the right way.
Right.
I mean,
Right.
it's just, and if it wasn't that way, we all would be complaining that the government's just giving out money willy, like the ERTC end up being kind of a disaster. The IRS is now, I guess, clawed back like $500 million and counting, and folks are getting put in jail because they basically just stealing the money. So that's why they have to do these. So I'm sorry, I think I was going a little crazy here,
No.
but I think so. Those sustainability goals are important, and they are incenting the right behavior. Because we want going forward to have an environment that we all can live in, not have global warming and all those things. But we also want to to shorten our supply chains. I mean, because we don't want to go through, again, what we went through during COVID. We just can't do that.
Right.
So it's actually really good government right now in that sense. I don't want to, but so, and I don't want to get too political, but I think when something is done right, I mean, we should recognize that.
Reward it.
Sure. So, and I think it makes perfect sense with the sustainability goals that the incentives are being aligned with.
Mm-hmm. Yeah. So, that makes a lot of sense. Yeah. So, well, it's been super insightful. Thanks for joining us.
Sure.
You're a natural. Yeah. We'll do it again in a year from now at the next IAMC
I would
conference.
like that. I enjoyed this. Thank you for your time. I appreciate it.
Yeah, great job. Thank you.
Thank you.
Yeah.
Thanks.
Awesome.